Welcome to the deep dive. Today we are taking the stack of sources for one of India's preeminent food exporters.
That's giant, really.
A giant, exactly.
Mm.
A company that controls a huge portion of the world's premium Basmati rice trade. We're diving into KRBL Ltd.
Yep.
We have their latest results package. So that's the Q2 and half-year financials ending September 30, 2025. We've got the management commentary, the investor deck, and crucially, the corporate governance updates.
And our goal for you is to get a really rapid and thorough synthesis of this. We need to understand three interwoven dynamics.
Yep.
First, the just, eye-watering financial growth they've reported. Second, the aggressive strategies, both domestic and export, that are driving those numbers. And third, the serious legal and governance issues that the company and, importantly, its auditors are grappling with.
You really need the complete picture here.
You do. It's the only way to understand this powerhouse.
Okay, let's unpack this with the performance data first, because the numbers for the first half of the fiscal year, H1 FY26, they show just immense momentum.
They really do.
Focusing on the consolidated results, the total income for the half year jumped to, what is it, Rs 3,155 crore.
Which is a huge 25% increase year over year.
25%.
And that operational growth, it translated directly into much, much higher profitability. This is where it gets really interesting.
Right.
Profit after tax, or PATI, for H1 FY26 was Rs 323 crore.
That's a robust 71% growth compared to the same period last year. 71%.
It's a huge jump, and if you zoom in on just the three-month period Q2, that profitability surge is even clearer.
How so?
The main operating margin metric, EBITDA margin, it surged to 16.6%.
Wow. Okay, and that's up from, what, 12.1% the year before.
Exactly. And the investor presentation is really specific about why. It says this massive margin improvement came primarily from a lower average Basmati cost of goods sold, or COGS.
So in simple terms, their main ingredient, the rice, just got cheaper to acquire during this period.
Precisely. That drove the profit line way up.
That's a powerful combination, isn't it? High revenue growth from high demand plus great cost management.
It is.
But then you look at their balance sheet and it's just screaming financial control. We often talk about companies struggling with debt, but here, the sources highlight their net bank debt position is reported as negative Rs 2,157 crore.
Which is a staggering position to be in.
Can you break that down?
Sure. In plain English, it means they are sitting on over 2,000 crore more in cash and bank balances than they have in outstanding debt.
So they're entirely self-funding. Cash rich.
Completely.
Wait, I am seeing another interesting number here related to their assets. Total inventory, as of September 30, 2025, was Rs 2,279 crore.
Okay.
That's actually lower than the Rs 3,013 crore they reported the previous year.
Right.
Now, if you're growing your top line by 25% and your exports by 86%, why are you sitting on less inventory? Is that pure efficiency or is that a risk?
That is the critical question. And the sources attribute that drop to two things: lower volume being held and a lower per unit carrying cost. So, given the massive export growth we're about to discuss, management clearly feels they've optimized their inventory cycles. They're likely just moving product much faster.
So it points to confidence.
Immense confidence in their demand forecasts and their distribution speed. It means they don't need to hoard aging rice stocks, which are, expensive to maintain. It all points to really effective working capital management.
That makes a lot of sense. Those numbers are spectacular. But it does raise the question, how? How are they actually making this happen on the ground? What's driving this performance?
Well, it all comes down to their core business. The company split into two segments: agri and energy.
Right. Rice and so on.
And the agri segment is the massive engine here. It's responsible for almost all of the revenue and those incredible profits we just went through.
And the undisputed star of that agri segment this half year has to be the export market.
Oh, without a doubt.
The sources note that H1 FY26 export revenue grew by an incredible 86% year over year.
86%.
That's phenomenal volume, but it's not just about volume, is it? It's about pricing power.
Exactly. This company commands a significant premium in the global market.
How significant?
The sources explicitly highlight that KRBL's Basmati export realization per metric ton was a stunning 41% higher than India's overall export realization average for the last fiscal year.
Hold on, 41% higher.
41%. It means for every ton they sell overseas, they are pulling in 41% more cash than their average competitor.
That is immense pricing power. It speaks to the strength of their flagship India Gate brand. Why is that premium so sticky?
It points to decades of quality control and brand consistency. Look, premium basmati rice is not a fungible commodity.
Right.
Customers overseas, especially in their key target geographies, they trust the brand's aging process, the grain length, the consistency. And if you look at the geographic focus, the Middle East, it accounts for nearly three-quarters, about 76% of India's total basmati exports.
So KRBL is clearly dominating that incredibly strategic region.
They are. They're maintaining market share against all comers through, well, heavy branding, including these high-visibility Arabic TV campaigns that are mentioned in the filings.
So export is booming, but the domestic battleground strategy is equally intense. They maintain market leadership in India, holding roughly 40% market share across both general and modern trade. And their investor presentation, it details this structured plan they call the transformation journey.
Yes, and this plan is all about infrastructure and visibility. It's built on 4 strategic pillars, very clearly laid out.
Okay, what's pillar 1?
The first is democratizing distribution. This is just an aggressive push for wider and deeper supply coverage. They want to make their product ubiquitous.
When you say aggressive, what are the metrics?
They currently boast a physical presence in 342,662 outlets.
Wow. That gives you a sense of the sheer scale.
It does. Then the second pillar is remodeling the supply chain management, or SCM.
Right.
And this isn't just a buzzword. No, the sources give specific actions. They're launching 16 CNFs carrying and forwarding agents and 8 stockist stations. This is all about cutting costs and getting better service into smaller, harder-to-reach towns.
Okay, and the third pillar?
Investing in the brand. This is essential for protecting that price premium we were just talking about. They mentioned 2 key initiatives: the Grains of Hope 2025 Social Responsibility campaign and the Make Every Moment Classic campaign with Mr. Bachchan.
So they're tying the brand emotionally to connection and time, not just to cooking.
Precisely. And finally, Pillar 4, which is crucial for future growth, foraying into new categories.
Right.
To expand their wallet share from existing customers, they highlighted the launch of the India Gate Classic Biryani Masala.
So moving beyond just rice and into adjacent high-margin categories like spices.
Exactly. They're capitalizing directly on their brand identity.
So that's a picture of just incredible operational confidence, right? Huge profits, massive cash reserves, and this very aggressive, very detailed growth strategy.
Absolutely.
And this is a big but. Every great story has that critical footnote, doesn't it? And that brings us to, well, the other side of the coin. The caveats.
The corporate governance and the legal uncertainty. This is where it gets complicated. We should first acknowledge a smaller governance update. The company addressed the September resignation of a senior figure, a Mr. Anil Kumar Chaudhary.
Right. The board commissioned an independent review by AZB and Partners to look into his departure, and the conclusion, noted in the filings, was that no irregularities impacting the financial statements were found.
Correct. But management did acknowledge the report identified areas where they can enhance their internal processes. So it suggests a forward-looking commitment to improvement.
That review builds some confidence, but it is almost instantly overshadowed by the fundamental risk flagged by the auditors.
This is the part of the filing that has to give you pause. Walker Chanyak & Co. LLP, the statutory auditors, they explicitly qualified their review report.
Both standalone and consolidated.
Both. And it's due to one major unresolved issue: the ongoing investigation by the Enforcement Directorate, the ED.
This is the critical context. The ED filed a criminal complaint under the Prevention of Money Laundering Act, the PMLA, against the company, its subsidiary KRBL DMCC, and one of its joint managing directors.
And the allegation is serious. It's alleged involvement in the high-profile Augusta Westland case. Specifically, the ED claims the company received USD 24.62 million in proceeds of crime between 2008 and 2010.
And this money was allegedly transferred through another entity and then via their own subsidiary, KRBL DMCC.
Correct. Now, the company did its own internal review and concluded they found no conclusive evidence to ascertain impact on the financials.
But what does the auditor's qualification actually mean for the health of the business?
It means the auditors are, well, legally hesitant. An auditor qualification is a serious signal to the market. While they acknowledge the internal review, they're stating that pending the completion of the ED investigation and all the potential consequences like fines, asset seizures, reputation damage, they're unable to comment on any adjustment that might be required to the financial statements.
So basically they're saying, we can't guarantee these numbers are final.
That's it. We cannot guarantee the numbers are clean because a major external legal risk could alter them completely. That uncertainty is the risk you, the learner, have to factor in.
And the filing also briefly confirms other legal matters are still open, right? They mentioned the dirty land attachment case involving property valued at Rs 1,532 lakh.
Yes, and they're also still waiting on a deposit refund of Rs 11,113 lakh. And even though an appellate tribunal ordered the ED to refund this money way back in March 2025, they still haven't received it.
Administrative delays, they say. But these aren't just footnotes. They represent real money and assets tied up in legal limbo.
Exactly. So when we zoom out, what stands out is this stark contrast. A company demonstrating near-perfect operational excellence, huge growth, massive liquidity, while navigating these complex, high-profile legal clouds that the auditors themselves say they cannot clear.
For you, the learner, this source material is a perfect live example of why you have to read these corporate filings cover to cover. The primary numbers, the investor deck, they tell a clear story of confidence and success. But it's the notes section and that auditor's opinion that provide the essential context about the risks that could dramatically influence future outcomes. You need both sides of that coin.
We've seen KRBL invest so heavily in their brand campaigns, in distribution. It all screams confidence in their operational future.
Right.
But the next hearing date for this ED case is scheduled for November 19th, 2025. That's just days after these amazing results were publicly released.
Literally days.
So the lingering question for you has to be this. How much does the uncertainty of these high-stakes governance issues ultimately weigh against the clear confidence management has in its strategy and its legal position?
That's the real tension here.
It is. It's something to really mull over as you track how the market digests this in the coming weeks.